Bookkeeping. What is bookkeeping? Bookkeeping is the process of keeping detailed records of financial transactions. Bookkeeping is done by bookkeepers. They record the day-to-day transactions of the business. The information is obtained from business documents, such as bank statements, receipts, invoices, checks, etc. The bookkeeper makes the records using a system called double-entry bookkeeping. Every business, no matter how small, must keep a record of every transaction. Case study. A small business owner's day-to-day activities usually involve managing their business and carrying out the role of a bookkeeper. As a bookkeeper, the owner's role would involve the following tasks: collecting business documents, recording data, posting data, including invoices, credit notes, checks, receipts, etc. The documents collected will be recorded in relevant books of prime entry such as the sales journal, purchases journal, and cash book. The data posted to the books of prime entry will then be posted to relevant ledger accounts. Accounting. What is accounting? Accounting uses the records of the bookkeepers to prepare the financial statements of the business. Accountants provide information to owners and managers which is used to monitor progress of the business, help with decision-making about how to improve profit or reduce loss. Accounting is the function carried out by accountants. Accountants are primarily responsible for managing, updating, correcting, and reporting the business accounts. What is the difference between accounting and bookkeeping? Accounting and bookkeeping have distinct functions. They support businesses at different stages of the financial cycle. Bookkeeping involves keeping records of the day-to-day financial data of the business. Accounting involves using the information recorded by the bookkeeper to provide information at regular intervals. Case study. Barbara runs a burger bar called Barbara's Burger Bar. She hires Jack as an accountant for her business. Jack runs his own accounting firm, 4J Accounting, with 3 other partners, James, Jasmine, and Junaid. Jack visits Barbara's place of business and explains to her the types of financial transactions he would like her to record as well as the rules and procedures for Barbara to follow in recording these transactions. Barbara carries out all of the bookkeeping of the business. After Barbara completes the bookkeeping, Jack takes the records and puts them to use. He transforms the records Barbara has collected in a way that can be used for decision-making. He creates financial statements which can be used to see where the business is spending its money, where it is making money, and the financial health of the burger bar. Jack will also conduct tax preparations and tax planning. Exam tip. The purpose of accounting and bookkeeping will usually appear on paper 1 as a multiple-choice question. The options might all sound relevant, but read the wording carefully to identify the purpose of the role, not the advantages of accounting or bookkeeping. Worked example. Which statement is correct? A. Accounting is the process of entering details of transactions into the books of prime entry. B. Accounting involves providing financial information for decision-making. C. Bookkeeping involves creating the financial statements. D. Bookkeeping is only carried out once a year. Answer. A is incorrect as bookkeepers enter details of transactions into the books of prime entry. C is incorrect as accountants create the financial statements, although bookkeepers might provide the information. D is incorrect as bookkeeping is performed day to day. The correct answer is B. Profit or loss. How does a business measure profit or loss? An accountant prepares an income statement for a business to show if the business is making a profit or a loss. The profit or loss is the difference between the total income and the total expenses. A profit is made if the income is higher than the expenses. A loss is made if the income is lower than the expenses. Why is it important to measure profit or loss? The information provided by financial statements shows the owner what has happened to the business during a certain period of time. This is usually a year. It can be used to monitor the progress of the business. If a profit is made, the owner is making money on their investment. If a loss is made, the owner might have to make changes to the business. Assets, liabilities, and capital. How does a business measure its financial position? An accountant prepares a statement of financial position to show assets, liabilities, capital. What are assets? Assets are things owned by the business. Premises, inventory, motor vehicles, money in the bank, etc. Assets also include amounts that are owed to the business by other people or businesses. Money owed to the business by credit customers. These are called trade receivables. Current assets are short-term assets that the business intends to liquidate within a year. Trade receivables, inventory, money in the bank, etc. Non-current assets are long-term assets that the business intends to own for more than a year and they are not easily liquidated. Premises, motor vehicles, etc. What are liabilities? Liabilities are the amounts that the business owes to other people or businesses. Bank loans, bank overdraft, etc. Money owed to credit suppliers by the business. These are called trade payables. Current liabilities are short-term liabilities which the business intends to pay within a year. Trade payables, bank overdraft, etc. Non-current liabilities are long-term liabilities which the business intends to take longer than a year to repay. Bank loans, etc. What is capital or owner's equity? Capital is any resource provided by the owner to start up the business or keep it going. This is sometimes referred to as owner's equity. Capital is often in the form of money. However, it may also consist of other assets, such as buildings, furniture, equipment, motor vehicles, goods, etc. The owner invests capital into their business. Technically, the business owes these assets to the owner. If a business makes a profit, then its capital increases. If a business makes a loss, then its capital decreases. What are drawings? Drawings refer to when an owner takes assets from the business for personal use. This could be money, goods, motor vehicles, etc. If the owner takes drawings from the business, then the capital decreases. The accounting equation. What is the formula for the accounting equation? The formula for the accounting equation is assets equals liabilities plus capital. The equation states that the assets of a business are always equal to the liabilities and capital of the business. You can rearrange the equation so that you can find one of the three values if the other two are known. Liabilities equals assets, capital. Capital equals assets, liabilities. The accounting equation. Exam tip. You may be given examples of assets and liabilities and asked to calculate the missing figure for capital. Worked example. The assets and liabilities are listed below for a business. Premises, 8,500. Equipment, 7,000. Inventory, 1,000. Trade receivables, 5,000. Trade payables, 4,500. Bank overdraft, 1,200. Calculate the capital of the business. Answer. Firstly, calculate the total assets. Premises, 8,500. Equipment, 7,000. Inventory, 1,000. Trade receivables, 5,000. Total assets, 21,500. Secondly, calculate the total liabilities. Trade payables, 4,500. Bank overdraft, 1,200. Total liabilities, 5,700. Finally, apply the formula capital equals assets, liabilities. $21,500 minus $5,700 equals $15,800. Why is the accounting equation important? The accounting equation may be shown in the form of a statement of financial position. The statement of financial position will be affected every time the business makes changes to the assets, liabilities and capital. Every single transaction will result in at least two changes which balance out. Both sides of the equation could increase by the same amount. Both sides of the equation could decrease by the same amount. Both sides of the equation could stay the same. Case study. Hannah is the owner of a business. Some of her transactions are listed below. After each transaction, the accounting equation still balances. Transaction. Effects on assets. Effects on liabilities or capital. A credit customer, Peter, pays the amount owed to Hannah by check for $1,120. Assets increase by $1,120. The money in the bank increases. Assets decrease by $1,120. The amount owed by Peter decreases. Overall, no change to assets. No change in liabilities or capital. Hannah pays the amount owed to a credit supplier, Rizwan, by check for $4,200. Assets decrease by $4,200. The money in the bank decreases. Liabilities decrease by $4,200. The amount owed to Rizwan decreases. Hannah buys additional fixtures and fittings for $5,500 on credit from FixFit Limited. Assets increase by $5,500. The value of Hannah's assets increases. Liabilities increase by $5,500. The amount owed to FixFit Limited increases. Hannah takes goods worth $500 from the business for personal use. Assets decrease by $500. The amount of inventory decreases. Capital decreases by $500. Hannah takes drawings from the business. Hannah transfers $1,000 from her personal bank account into the business bank account. Assets increase by $1,000. The money in the bank increases. Capital increases by $1,000. Hannah invests $1,000 into the business. Hannah makes $20 profit by selling goods which cost $30 for $50 cash. Assets increase by $50. The amount of cash increases. Assets decrease by $30. The amount of inventory decreases. Overall assets increase by $20. Capital increases by $20. A profit has been made. Worked example. A business pays one of its trade payables by check. Identify the effects on the business, assets and liabilities. Effect on assets. Effect on liabilities. A. Reduce bank. Reduce trade payables. B. Increase bank. Increase trade payables. C. Reduce trade payables. Reduce bank. D. Increase trade payables. Increase bank. Answer. Money in the bank is an asset and trade payables is a liability. A payment made by check would reduce the money in the bank, therefore reducing the asset. Trade payable is a liability. The business debt would be reduced when payment is made. The answer is A.